are joined again by Ivette Amidan, the Mortgage Diva and the Queen of Deals in Heels. Ivette, thank you for joining us as we get down with down payments. So let's talk. What is a down payment? What necessarily does that mean? I feel like a lot of people don't expect such a thing as a down payment, so tell us about it.
Well, that's actually a good question. I just feel that it's not that people doesn't expect a down payment. Sometimes they have they don't know the difference between maybe a closing cost and down payment, because when I do explain down payment and then I go into closing costs, they're like, what, wait, there's closing costs? What is that? So they think like down payment and then everything is together, and it's not.
Right. So how much would you need for a down payment? How is that calculated?
Well, it depends on the type of loan. Conventional is usually 5% down, but our most popular is a 20% down because it eliminates mortgage insurance. It's private mortgage insurance. So that takes away anywhere from $150 to like $300 off your payment.
Absolutely. It's so when you purchase a home, there is down payment, and that's the amount of cash that you put towards the transaction. So,
and down payment basically guarantees, yes, like I'm purchasing the home. It's a deposit, right?
yes, it's part of the purchase price that you pay out of your pocket. It's your skin in the game. If you're buying $100,000 worth of property and you're getting an FHA mortgage, that's 3.5% or $3,500. You put in $3,500, the bank puts in the other $96,500. So it's your skin in the game. Closing costs are the expenses to get that loan. So it's everything else that's associated, your inspections, your appraisal, your insurance, so on and so forth. It's like, right, it's like when you buy a car, you don't just buy the sticker tag. There's taxes, and then there's registration fees, and there's other things that you spend in addition to what that car costs. So down payment is your skin in the game. Closing costs are the expenses to get that house. Now, what you're talking about, mortgage insurance, is when what's included in your payment. If you put in any loan less than 20% down, you are a higher risk to the bank because you don't have as much skin in the game as if you had put a large down payment. So to protect banks, to protect themselves against the risk of a low down payment borrower from defaulting, they have an insurance policy, and that's called private mortgage insurance. And it's significant. So for example, on a house that's $400,000, your payment would be, and I'm estimating, you're gonna have to correct me, I'm gonna say it's gonna be close to $2,800 or so with 5% down?
Yes.
Okay, and out of those $2,800, $300 are strictly private mortgage insurance.
Exactly.
That's it. So if you put 20% down, you don't have that $300, and your payment would be $2,500.
Exactly.
Exactly.
And so obviously all these numbers depend on situation. So what are like the guidelines used for conventional financing?
Well, the guidelines, so conventional, if you have a 700 and under, usually in
Your
credit score, I usually don't recommend conventional. Because, like Catherine said, it's a little bit of higher risk because then your mortgage insurance is through the roof and your interest rate is higher. So conventional loans are kind of picky when it comes to credit score. So I always recommend a 700 and higher for a conventional loan. Now, is it possible to get a conventional loan with under 700? Yes, it is. But your expenses are going to be higher. With the conventional loan, not only is it are good for, everybody thinks that conventional loans are not for first-time home buyers, and they're wrong. But conventional loans have actually come out with first-time home buyer programs that allows as little as 3% down.
That's
crazy.
Huge. Yeah. Wow.
Okay? So you do have to be a first-time home buyer.
Right.
If you're not, then you go up to 5% down. And conventional loans also are good for second homes and investment properties.
Nice. So I'm a first-time home buyer. I'm scared. What do I need to just basically be good for a loan? How do I prepare myself to purchase a home?
Well, this is what we would discuss during the buyer consultation.
Right.
We would figure out what your concerns are, what your assets are, how much money do you have in the bank, what you're comfortable with. You know, you may have 10,000 in the bank, but you'd rather not spend it. Or maybe you are only willing to allocate a certain amount of cash to this endeavor. So we identify all of your concerns, and then Ivette has a variety of programs because, like she said, conventional is not the only way. Conventional is definitely the smartest if you're able to do 20% down, because then the numbers really play to your favor. But if you're just starting out or your credit is less than 700, there are other options.
Yes.
Such as FHA.
And FHA has like a bad reputation, but it's really not. FHAs are really good loans. They start you off with as little as 3.5%. You can have a 640, a 580, and you will still come in with your minimum payment of 3.5% down payment. So that's huge, right? Your mortgage insurance stays the same. Whether you have a 580, or a 680, it stays the same. So FHA loans are actually really good, especially for those who are first-time home buyers and don't have that much savings. FHAs are really good loans. I'm sorry.
Okay, so basically it's all about strategy. If it applies to you, they're the experts. They will find a program for you that works. So now let's talk about military families. There is such a thing as a VA loan. What does that entail? How can that benefit someone?
Well, VA financing affords you 0% down payment. So what we were just talking about, conventional 20% down, FHA 3.5%. Veterans have the option of not putting anything down, and that's a thanks for your service. However, there are still closing costs for a VA loan, so there are still expenses associated. So that's something that we would make sure you qualify for your VA. We would make sure how much you qualify for, depending on your discharge level. There are incentives for an individual that may have retired at a higher level of service than another, or achieved certain things. So it varies from one person to the other. We want to know exactly what's available to you. The interest rate is dictated by that as well. And then again, we identify your goals. If you want to really buy a house with 0 out of your pocket, it comes down to negotiation. As agents, we would negotiate on your behalf to make sure that the expenses are covered by a seller credit, ideally. That way it's 0 out of your pocket. But what are the requirements for that, other than obviously qualifying for VA?
Well, before I get into that, I do want to say that, Catherine, you're a hell of a negotiator. I've seen your negotiating skills, and let me tell you, you're a beast. So I just want everybody to know that if you want a good agent that will just negotiate your closing costs, Catherine is the one. That is me. Let me go.
We're very busy.
Yeah,
this
sorry.
This is real-time podcast
This is real
recording.
time. Exactly, and that's my fault.
We're all in it.
We are. We're working every day. So, yeah, if it's something that for some reason you don't end up negotiating, obviously that would come out of your pocket, and it would have to be cash. What else do we have for VA? Do we have any more notes? The phone threw me off.
Sorry. So VAs are actually one of my favorite loans because they're such good loans, especially for our military families that we're really, really thankful for. Like Catherine said, it's 0 down payment and you pay no mortgage insurance. So it does depend, by each client and the different circumstances, but all of the VA loans are just amazing, and one of the things that I love about VA is that it gives you a lot of leniency when it comes to credit score and your debt to income ratio. So your debt to income ratio usually for normal loans are 45. For VA, I mean, I've done VAs at 78%.
Really?
Yes.
Oh, that's really high. So what she means by debt to income ratio is if we make $3,000 gross a month. There's the financing guidelines say that only so much of that income can be used for your housing expense, and then that plus your other expenses, your car payment, your groceries, etc., can only use a certain percentage of that income. So those ratios shift depending on the loan program, and that's what she's talking about. So there's some flexibility for VA buyers.
There's a huge flexibility
I've
for
never
VA
seen 78%.
buyers.
That's
Yeah,
crazy.
I've done it at 78% LTV. With the regular loans, what the banks like to see is 45%. With certain circumstances, they go up to 50, but that's it. And with VA, I've done it up to 78% LTV.
Oh,
Crazy.
I mean, debt to income, sorry. So I love VA loans. I love the flexibility that military buyers and their families have, and I would love to help military families.
Yeah, that's definitely fulfilling and great because their service to our country cannot even be like measured in any way. They do so much. So basically, the only cash you need for a home payment, technically, is the down payment and the closing costs. And that is something both of you would analyze prior to even making an offer, correct?
absolutely. During the consultation, it's something we would identify. As a recap, I would like to say, because this episode is about down payments, is you, as a first-time home buyer or somebody who might have a few credit blemishes, we're not quite at that 700 mark, you have FHA available to you with 3.5% down, and your FICO score could be as low as 640, right?
Yes.
And then if your FICO score, your credit score is 700 or above, then of course you have conventional financing, which could be as little as 3% down.
Correct.
And to save yourself the most money, 20% down is ideal. But usually people do that on their second home. It's when you've achieved a little bit of wealth. And now, this is something we were talking about last week. If you're purchasing a second home, let's say I own a house now, and I bought it as an FHA, and I want to purchase my upgrade home. My family has upgraded and I want an upgrade. Can I then go to a conventional 5% down?
Yes, you can.
Okay, and what if I want to buy an investment property or a second home?
Well, a second home as far as, like, out of
Like I want to buy one in Lake Tahoe.
Yes. So if you want to buy a second home, the down payment for a second home are as little as 10% down.
Great. And for investments, I know that 25% down will be available with conventional.
Yes, that is for multifamily. For just a single family residence, it's 15%.
Also, if I want to buy a rental, 15%
Yes.
down. Gotcha. Great. One last thing, FHA can be used if you do want to buy multifamily. The catch is that you must live in one of the units.
Yes, that is correct. You must live in one of the units because the FHA is for owner occupied.
Cool.
Okay.
And so, if you're like me and super confused by all these numbers, you can definitely contact Ivette and or Catherine. Both of their socials and anything, websites are all linked in the video description, so go there. And obviously, these ladies have been in the game for quite some time. So, you don't need to be scared about catching a good deal with
We're
these
veterans.
two. Honestly, but ladies, thank you for getting down with the down payments. I hope that cleared things up for you. Basically, it's just a game. It's all about strategy, and you contact the experts, and they help you out. They fix.
Absolutely.
Teamwork makes the dream work, and this is your team. So,
Thank you.
yeah, thank you, ladies, for joining.
Thank you.